Introduction to corporate finance is what we will be talking in today's video. So one of the most important questions that we need to answer regarding corporate finance is what long-term investment should the firm take on? Where will it get the financing part of it? That is most important to repay for the long-term investment that it is going to arrange. How will we manage the everyday financial activities of the firm? Remember, we are talking only about corporate financing. So financial managers have a lot of responsibility onto them. The chief financial officer, the top financial managers within a firm, treasurer oversees cash management, credit management, capital expenses, and the financial planning thereby. So we are looking forward towards it. Controllers oversees the tax, cost accounting, financial accounting, and data processing. This is the finance manager talking around. We are talking about the CFO, the treasurer, and the controller. The decisions, what are they? They are talking about capital budgeting. What long-term investment or project should the business take on? This is very important. What about the capital structures? How will we pay for the sale for our assets? Should we use debt or should we just go for equity perhaps? And working capital management, WCM, how do we manage the day-to-day operations, day-to-day cash management of the firms? So yes, the financial management decisions are capital budgeting, capital structures, and working capital management. Forms of business organization, primarily in US and predominantly elsewhere. It's more or less the same thing. We are talking about sole proprietorship. It is where an individual holds the complete control over a firm. Then we might have partnership. It is more than one individual, two individual, three individual, perhaps plenty money. And then there are corporations where n numbers of corporations. It's a board that is running the company altogether on a corporation mode altogether. So yes, single owner for sole ownership, general or limited partnership. It might be limited liability partnership, private limited partnership, as the case might be. Corporation, we are talking about the core corporations, as in the limited liability corporations. So for sole partnership, what are we looking into it? We should go across as the case might be. Sole proprietorship is all the advantages, the positive things that comes around it. It is at the whims and fancies of the individual. He or she does not have to depend on somebody else. Easiest to start. It is one of the least regulated. Single owners keeps all the profit. There are no dispute about it. There are no other sort of arrangement taxed once as only as a personal income. Since this is a sole owner's proprietorship, the disadvantages, there are plentiful about the disadvantages thereby. It is limited to the life of the owner. The owner dies, expires, so that the company, and because nobody else is going to own that company altogether. And the limited life to an owner. Equity capital limited to the owner's personal wealth, and that is completely up to the owner spending habits. Unlimited liabilities, definitely yes, since the owner is looking at the ownership or of the sole proprietorship. Everything that goes wrong should always land onto his or her table. Difficult to sell the ownership interest per se. Now let us talk about the partnership. We are talking one at a time for every other things that goes around it. Partnership was either of general or of limited partnership. Partnership that goes along with the advantages is, and what are they? Two or more owners? Probably yes. The risk is shared. More capital is available for the markets altogether. Relatively easy to start. Relatively, again, I keep on saying about this. Income taxes once as a personal income as on when on basis. Disadvantages, plentiful of disadvantages, because it has again an unlimited liability, something similar to sole partnership, because it is all the partners who have the vested interest and they are responsible for all the upcomings or ongoing happenings in the organization. So we can have two kinds of partnership where we can have a general partnership and a limited liability partnership altogether. Partnership dissolves when a one partner dies or probably wishes to sell his or her stake, and definitely it's difficult to transfer the ownership thereby. Let us look at the corporation now. Looking at the corporation, what are the positives, advantages, and the disadvantages thereby? This advantage is a limited liability. If something goes wrong with the business, the owner cannot be traced or probably cannot be pinpointed or accused of some wrongdoings. Unlimited life, despite the fact that the owner might expire the corporation will extend and will live beyond the means. It might live beyond few centuries altogether, and there are plentiful of example of such corporation. Separation of ownership from the management, as in the man who runs the show and the show which has been run around it. The organization is doing the business and somebody is running the business thereby. So ownership and management is completely two different entity. Transfer of ownership is definitely easy and easier to raise capital because it is bit of transparent, because there are no vested interest that is playing in the rule. The disadvantage is thereby separation of ownership and management. Yes, if something goes wrong, whom will you stand to accuse? Probably no one. You have got nothing to go around it. Double taxation, once as an income tax of the corporate trade and then as a dividend tax which has been paid at a personal rate. So you have been taxed twice. The goals of the financial management, and how do we come across to the goals of the financial management, and that is very important. What should be the goal of a corporation? You should ask not once, not twice, but every time that you want to go around it. We are talking about minimizing profits, we are talking about minimizing costs, we are talking about minimizing, or should I say maximizing market share, and minimizing any wastage of effort or something like that. So maximize the current value of the company stock per se. Does this mean we should do nothing and everything to maximize the owner's wealth? Is that the case altogether? The agency's problem here, we need to come across as what is the problem of the agency. Agency's relationships with the owners of the firm. Principal hires an agent to represent probably his or her interest as such. That is what we are looking into. The stockholders are the principals. You remember, they hire managers or agents to run the problem. It is not an issue that has been owned by the managers, right? They are also an employee. It is not an interest for the agents because they are working for money, but are no way interested into the up about the market share and the quality of the product and so on and so forth. The agency problem is conflict of interest between the principal and agent. The principal would love to attain the maximum value of the money invested, whereas the agent would love to see the quality is not been compromised. The agent would love to see that there is a safety issues are not been compromised as far as the employees are concerned. Management goals and agency costs are completely different altogether. So let us managing the managers thereby, and how do we go around it? We talk about compensation. We talk about managerial compensation. Can we incentivize profitability? Incentives can be used to align management and probably stockholders' interest thereby. The incentive needs to be structured carefully to make sure that they achieve their goals absolutely on bang on. Then we have the corporate goals. The threat of a takeover may be maybe by a better management that's always lurking around here. Probably even the agents might find a good, decent, much well-paying jobs in a different environment, a different company, and chooses to switch this off because there are no vested interest that comes around it as an agent, right? So principal has to look into such kind of scenarios, and then there are other stakeholders which we need to keep abreast with. Yes, we are talking about the financial market, and I've shown you a deliberate photographs out here because why the dollar is flowing the direction it is making the most money. So that is what we are looking into. Is the cash flow of the firm needs to be ascertained. Primary versus secondary market, dealers versus auction market, listed versus over the counter security, as in NYSE, New York Stock Exchange, NASDAQ. This is also an index where all the technological shares are actually being traded around here. What are we talking about? The financial markets. Then there is an ethical issue that needs to be addressed around it. Wherever there's money, wherever there's profitability, wherever there's earning, ethics do plays a role. Is it ethical for a tobacco company to sell a product that is known to be addictive and dangerous to the health of the user? Is it relevant that the product is legal? Now you need to occupy this particular stratum, but there are certain things which are detrimental to your health, and the company is maximizing profit upon that company. Definitely, it might give you a short-term kick, but eventually it does not matter. It doesn't help you in the longer version, and that is you need to answer those questions time and again, as on when on basis. So, should board of director considers only the price when faced with the buyout offer? Just the price? The more the money is becoming, should the owners looking into it, or should the owners also look into the welfare of the employees they have been working for? the employees that have been working for their lifetime with the owners altogether. What should be the issue? Is it ethical to concentrate only on the shareholders' wealth, only the wealth, and should the stakeholders be also be considered? Stakeholders, there might be employees. Why don't you think the customers are not the stakeholders? Even they are the stakeholders. So what are we trying to do? We are trying to take pockets money from the pockets of the customer and putting in our pocket. Is it fair altogether? And how fair it should be running through? Should the firm be penalized for attempting an improving return by stifling competition, as in monopoly, by striking out competitors by hooks or crooks? Is that the fair thing? With this, I come to an end of this video. Thank you for watching it.